Welcome to our weekly report. In this week has seen some notable impacts on different aspects of the US market. Let's start with stock market movements and index developments. The S&P 500 index has managed to briefly break out of its trading range by breaking above 4,200 points in intraday trading. This level has not been reached since late August. It is important to note that the index has traded within a narrow range in recent months, which has caught the attention of T-row price traders. In fact, this week marked the sixth consecutive period in which the index did not move more than 1%, the longest stretch since November 2019. Let us now turn to the performance of individual market sectors. This week, several large-cap technology-related stocks outperformed. In particular, shares of Alphabet, Google's parent company, and Meta Platforms, Facebook's parent company, rose strongly. In addition, chipmakers such as Nvidia and Advanced Micro Devices, AMD, also posted solid gains. Notably, regional bank stocks also rebounded, reversing some of their recent losses. As for the debt ceiling negotiations, this week has seen a remarkable turnaround. After a meeting at the White House, President Joe Biden expressed confidence that there would be no default. Similarly, Republican House Speaker Kevin McCarthy called a deal doable, while Senate Democratic leader Chuck Schumer said that a bipartisan agreement is the only way forward. Elsewhere, the yield on the 10-year U.S. Treasury bond rose sharply during the week. The rise was driven by employment and manufacturing data. Pressure was seen in the tax-exempt municipal bond market due to new trades in the market. In addition, primary issues of investment-grade primary corporate bonds significantly outperformed weekly expectations. According to our traders, Pfizer's new issuance was the fourth largest in history. In contrast, the high-yield market recorded somewhat low volumes throughout the week as investors digested the headlines on the debt ceiling and the positive momentum towards a deal.
We continue with the situation in Europe. We start with the news that European equities advanced amid optimism that interest rates are close to a ceiling and that the US will avoid a debt default. In Europe, the Pan-European Stocks Europe 600 index closed the week up 0.72% in local currency terms. The German DAX rose 2.27% and the French CAC 40 gained 1.04%. European government bond yields also rose on expectations of progress in the US debt ceiling negotiations. The yield on the German 10-year bond reached 2.5%, its highest level in more than 3 weeks. And in the UK, the yield on the 10-year UK bond rose above 4%, with policymakers hinting at the possibility of monetary tightening if inflationary pressures do not moderate. The US debt ceiling negotiations also had a positive impact on investor sentiment in Europe. There was widespread optimism that a US debt default would be avoided, and this contributed to the improved tone in European markets. The week closed with a review of economic data and the industrial situation. On the one hand, official data indicated that industrial production in the euro area weakened more than expected. Data for March indicate that industrial production fell by 4.1% from the previous month, and in year-on-year terms it declined by 1.4%. This weakening was observed not only in Ireland, but also in Germany, France and Italy. However, the European Commission raised its economic growth forecasts for the Eurozone for both this year and next. According to the new projections, gross domestic product, GDP, will grow by 1.1% in 2023 and 1.6% in 2024, beating expectations and boosting wage growth, with a forecast of 5.8% this year and 2.8% in 2024.
In China, equities traded mixed. Investors expressed concern about the country's recovery after the crisis. The Shanghai Stock Exchange gained 0.34%, while the CSI 300 index added 0.17% in local currency terms. In Hong Kong, however, the benchmark Hang Seng index declined by 0.90%. The slowdown in growth was supported by official data indicating lower growth in April compared to a year earlier in industrial production, retail sales and fixed asset investment. Although unemployment fell to 5.2% in April, down from 5.3% in March, youth unemployment reached a record high of 20.4%, raising concerns about the recovery and attracting new talent. These figures were seen as disappointing by investors, although they were affected by the comparison with the previous year, when China was under lockdown due to the pandemic. Continuing with we now focus on the People's Bank of China, PBOC, and the foreign exchange market. The PBOC injected 125 billion yuan into the banking system through its one-year medium-term lending facility, exceeding the 100 billion yuan in maturing loans. The interest rate on medium-term loans remained unchanged, in line with expectations. In its quarterly monetary policy report, the PBOC pledged to maintain sufficient credit growth and liquidity in the economy, raising expectations that the central bank would intensify easing measures in the coming months. We end the week with information on China's real estate sector. New home prices in 70 of the country's major cities rose by 0.4% in April, marking the fourth consecutive month of increase. However, there was a slowdown compared to the 0.5% growth recorded in March, according to official data cited by Reuters. The slowdown comes after data revealed a steep drop in real estate investment and sales in April.
Thank you for watching our video. If you would like to learn more about our services, please feel free to contact us at Gladstone Associates, Provident. Also, you can follow us on our social networks to stay up to date with our latest news and updates.